Hey, welcome to your personalized deep dive all about the wheel options trading strategy.
Sounds exciting.
We're focusing on the insights from Insider Finance's complete guide to the wheel options trading strategy.
Published in June 2024.
Right, June 2024, so pretty recent.
Yeah.
Um, and you're already familiar with options, but we're really focusing on how you can actually use this strategy to buy stocks at a discount and generate some income.
Oh,
Even before you own them.
before you even own the stock.
Before you even own them. So pretty powerful stuff.
Yeah, that is one of the things that makes the wheel strategy really intriguing is that it's a very cyclical approach.
Okay.
It's not like, you're in and out, you're trying to make a quick buck. It's really, a very methodical way to build a portfolio that generates income.
Okay, so let's break down this cyclical approach.
Yeah.
It all starts with selling put options, right?
Right.
But how do we actually choose the right put options for this strategy?
Well, it's
How many factors to consider?
it's almost like baking a cake,
Okay.
where the right ingredients are really key to having, a delicious outcome.
Okay.
So you really want to make sure you're focusing on stocks that are relatively stable, that have good liquidity,
Okay.
and ideally stocks that you're comfortable holding long term.
Okay, so we're thinking blue chip stocks. We're thinking those well-established companies that have a history of, steady performance.
Yeah, exactly.
Right.
And then when you go to select the strike price for your put options, you want to think about a level where you'd actually be happy to own the stock.
Right.
If it were to drop down to that price. So it's almost like setting a buy limit order, but you're actually getting paid a premium
Right.
for that privilege.
I like that. That's an interesting way to think about it.
Yeah.
So we've sold our puts,
Right.
we've collected our premium, and now we wait.
Yep.
What happens next?
So there's really two possible scenarios that could unfold.
Okay.
If the stock price stays above your strike price,
Okay.
then those put options are going to expire worthless. And you just get to keep the entire premium.
That's the ideal scenario.
Pure profit.
Pure profit. That's what we like.
Right.
But what if the stock price dips below that strike price?
Yeah, then you might get assigned on those put options, meaning you're obligated to buy the stock at that strike price.
Oh, okay.
And that's really where the wheel and the wheel strategy starts turning.
Gotcha. So now we own the stock.
Right.
What's the next move?
Well, now you kind of shift gears and you start selling covered call options.
Okay.
So you're basically giving someone else the right to buy the stock from you at a predetermined price. And once again, you're going to collect a premium for that.
Okay.
But ideally, the strike price that you choose for your calls is going to be higher than your effective purchase price.
Okay.
Remembering that premium that you received for the puts,
Right.
so that if the option is exercised, you're actually selling that stock at a profit.
Got it. So we're either collecting premiums by selling puts,
Right.
or we're generating income by selling those covered calls.
It's like a continuous cycle
It is.
of just generating cash flow while strategically, entering and exiting these stock positions.
Exactly. And that's what makes it so powerful. It's almost like a two-sided coin, each side offering this potential profit opportunity.
Right.
But to really maximize this strategy, you need to understand this concept of time decay, or what options traders refer to as theta.
Yes.
Yeah.
Theta, the silent force working in our favor.
Yes.
Can you explain how that specifically benefits the wheel strategy?
Absolutely. So think about it this way. An options value, much like a melting ice cube,
Okay.
diminishes as it gets closer and closer to its expiration date.
Right.
And the shorter the time remaining, the faster the decay happens.
Makes sense.
And that's what we want as sellers of options.
Gotcha. So shorter term options generally offer more opportunities to profit from that time decay.
Yes, that's true. But they also require more active management because you're constantly, resetting the wheel, choosing new strike prices, assessing market conditions.
So there's a trade-off there.
Between frequency and intensity,
Yes.
those shorter term options are like those frequent flyer miles.
Yes.
You're getting those trips, but it demands a lot of attention.
Yeah.
Whereas those longer term options are like a leisurely cruise.
Right.
Less frequent, but potentially a little more relaxing.
Yeah, I love that analogy. That's a really great way to put it.
Thanks.
It really depends on your individual trading style and risk tolerance,
Right.
Some traders thrive in that fast-paced nature of shorter-term options, while others prefer the flexibility and potentially larger premiums
Right.
that you can get with those longer-term options.
Okay, so we've talked about time decay,
Yeah,
but another major factor in options trading is volatility.
absolutely.
How does volatility impact the wheel strategy?
Well, volatility is kind of like the wind that propels that Ferris wheel.
Okay.
It can make the ride a little more exciting, but also a bit more unpredictable.
Right.
And higher volatility usually translates into higher premiums, which can be very tempting.
So more volatility, more potential profit, but also more risk.
Exactly. It's a double-edged sword
Okay.
because that higher volatility also increases the chance that your options might be assigned,
Right.
meaning that you might end up owning a stock
Oh.
at a price that's less favorable than you anticipated.
Okay, so how do we navigate those choppy waters, especially if we're aiming for those juicy, high volatility
Well,
premiums?
that's where understanding the Greeks comes into play.
The Greeks.
Now, these aren't those mythological creatures you might be thinking of.
Okay, good.
They're really just key metrics that help us understand how options prices behave.
Okay.
And for wheel traders, a deep understanding of the Greeks is essential for managing your risk and maximizing your profit potential.
Okay. I'm ready to unravel the mysteries of these Greeks.
Okay.
Let's start with delta.
Yeah.
How does delta specifically impact the wheel strategy?
So think of delta as like the speedometer of our option.
Okay.
It tells us how much the option's price is expected to change for every dollar move in the underlying stock. Got it. So for wheel traders, delta is crucial when you're going to select your strike prices.
Okay, so if we're selling those put options, a lower delta would mean the option is less sensitive to those stock price drops,
Yeah.
reducing the chance of assignment.
Precisely.
Okay.
And when you're selling those covered calls, a higher delta would mean the options price will move more favorably if that stock price rises,
Okay.
potentially increasing your profit if that option is exercised.
Gotcha. So delta is really helping us gauge the likelihood of those options being exercised,
Yeah,
which directly impacts, how we implement our strategy.
it does.
Now, what about gamma?
Okay, so gamma is kind of like the acceleration of our speedometer.
Okay.
It measures how quickly delta changes.
Yeah.
So essentially, it's telling us how much delta is going to jump or dip
Right.
with each fluctuation in the stock price.
Okay, so gamma is all about understanding how sensitive our delta is
Yes.
to those stock price movements. And why is that important for the wheel strategy?
So gamma really helps us anticipate how rapidly our options price might change, especially when we're dealing with those volatile market conditions.
Okay.
It's particularly important for managing risk
Okay.
because a high gamma can lead to those really rapid price swings,
Right.
potentially, increasing the chance of assignment or limiting profit potential.
So gamma is like our volatility radar,
Yes.
letting us know if there's turbulence ahead.
Yes, great way to put it.
We've already covered theta, which is all about that time decay.
Yeah.
But what about vega?
Okay, so Vega measures an option sensitivity to changes in implied volatility,
Okay.
which is really just the market's expectation of how much a stock's price is likely to fluctuate in the future.
Okay.
And for wheel traders, understanding Vega is crucial
Okay.
for anticipating how changes in implied volatility are going to affect your premium income.
So if a stock's implied volatility increases,
Yes.
the premiums on its options will generally rise as well, offering us that higher potential payout.
Exactly.
Sweet.
And conversely, if implied volatility decreases, those premiums are likely going to decline.
Okay.
So Vega helps us kind of gauge those fluctuations and adjust our strike prices accordingly.
It's like having a weather forecast for volatility,
I like that.
helping us prepare for those potential storms or maybe enjoy some calm sailing.
Yeah.
And what about rho,
Okay, so Rho.
the last of the Greeks?
Rho measures an option's sensitivity to changes in interest rates.
Oh, okay.
And while it's less critical for shorter-term option strategies like the wheel,
Okay.
it's still something worth keeping an eye on, particularly if you're playing a longer-term game.
Gotcha. Okay, so we've covered the Greeks.
Yeah.
And it seems like they're essential tools for understanding and implementing the wheel strategy effectively.
Absolutely.
Yeah.
They provide those valuable insights into option pricing dynamics, and they really help you make those more informed decisions, whether you're choosing your strike prices, managing risk, or adjusting your strategy based on market conditions.
It's like having a whole dashboard of instruments, each
Oh.
giving us those crucial data points
Yeah.
to navigate the complexities of options trading. So far, we've explored the cyclical nature of the wheel strategy, the importance of time decay and volatility and how those mysterious Greeks
Right.
can help us make those informed decisions.
Yes,
But like any investment strategy, the wheel strategy has its pros and its cons.
of course.
So let's dive into those a bit, shall we?
Absolutely. It's crucial to go into any investment with a balanced perspective.
Right.
Really understanding both those potential upsides, but also those potential downsides.
Absolutely. So let's start with the good stuff.
Okay.
What are some of the key advantages of using the wheel strategy?
Well, one of the most appealing aspects of the wheel strategy is its potential for consistent income generation
Okay.
through those premiums.
Okay.
So instead of just, waiting for a stock to appreciate,
Hmm.
you're actively generating cash flow, regardless of whether the market's going up, down, or sideways.
Yeah, it's like creating your own dividend stream,
That's a great way to put it.
but with potentially higher yields than those traditional dividend-paying stocks.
Yes, exactly.
Yeah.
And because you're collecting those premiums up front,
Okay.
the wheel strategy can also offer a degree of downside protection.
Okay.
How so? Well, those premiums act as a cushion, mitigating those potential losses if the stock price happens to drop.
So it's like having a built-in safety net,
Yeah,
but it's not foolproof.
right. Of course not.
What are some of the risks or disadvantages that we need to be aware of?
Well, one of the key risks is the potential for stock depreciation.
Okay.
So if you get assigned on that stock after selling a put option
Okay.
and the stock price continues to fall,
Right.
you could end up holding a losing position.
So those premiums we collect might not offset a significant drop in that stock price.
Exactly. And it's kind of like buying insurance.
Okay.
It helps mitigate those losses, but it doesn't eliminate risk entirely.
Right. And that brings us to another consideration, capital requirements. The wheel strategy does require a certain amount of capital to cover those potential stock purchases
Right.
if those put options are assigned.
Yeah.
And that can tie up funds that you might otherwise use for other investments.
Absolutely.
So it's not a strategy for those with limited capital.
Right.
You need to have sufficient funds available
Yes.
to comfortably buy those shares if you get assigned.
Precisely. And remember, the wheel strategy is not a set it and forget it approach.
Okay.
It requires ongoing management and monitoring.
Okay.
You need to keep a close eye on your positions, adjust those strike prices or those expiration dates as needed,
Right.
and be prepared to make decisions quickly based on those market movements.
So it's not for those passive investors.
Right.
It requires, active participation.
Yes.
And a willingness to adapt to those ever-changing market conditions.
Exactly. It's almost like, sailing a ship.
Okay.
Through choppy waters, you need to constantly adjust your course, trim those sails, and be prepared for those unexpected gusts of wind.
That's a great analogy.
Thanks.
Now, based on your experience, what are some of the common mistakes that traders make when implementing the wheel strategy, and how can we avoid those pitfalls?
So one of the most common mistakes, and this applies to really any trading strategy,
Yeah.
is emotional decision-making.
Oh, yeah. Fear and greed get in the way.
Exactly. Fear and greed can really cloud your judgment
Right.
and lead to those impulsive actions that can derail a carefully crafted plan.
So it's important to, have a predefined strategy, stick to it, and not let those emotions dictate our trades.
Absolutely. Another common mistake is ignoring those broader market trends.
Okay.
The wheel strategy doesn't exist in a vacuum.
Right.
It's essential to be aware of those economic indicators, those industry news, and that overall market sentiment,
Yeah.
because those factors can significantly impact those stock prices.
Right. So we can't just focus on those individual stocks.
Right.
We need to be aware of that big picture.
Exactly. It's like checking the weather forecast before you set sail. You want to know if you're heading into a storm or if you're going to be enjoying those smooth seas.
Right. And speaking of individual stocks,
Yeah.
another pitfall is that overexposure to a single stock or even just a small group of stocks.
Yeah, diversification is key to managing risk.
Okay.
You don't want to put all your eggs in one basket, as they say.
Right. So spreading our risk across different sectors and industries can help, create that more resilient portfolio.
Exactly. And finally, a mistake that can really derail any trading strategy is neglecting those exit strategies.
Oh, right.
So before you even enter any trade,
Okay.
you need to have a clear plan for when and under what conditions you're going to exit that position,
Right.
whether it's at a profit or a loss.
It's like having those predefined exit points
Yeah.
can help us avoid making those emotional decisions in the heat of the moment.
Absolutely.
Like having a safety valve that automatically releases pressure when things get too hot.
I love that analogy. That's a
Yeah.
great way to put it. It's about having a plan and sticking to it, even when things get a little bumpy on that trading journey.
Okay, so we've talked a lot about the strategy itself, but let's get down to the nitty-gritty.
Okay.
How do we actually calculate our potential profits and losses?
Well, that's where understanding the math behind the strategy comes in.
Okay.
Don't worry, it's not as complicated as it might seem.
Okay, good. I was a little worried there.
Yeah.
But break it down for us. What are those essential calculations that we need to master?
So the most important calculations really involve understanding, Option premium calculation, profit and loss analysis,
Yeah.
and break-even point determination.
Okay.
Remembering that premium is the price that you receive for selling an option.
Okay.
And it's influenced by several factors, including, the volatility of that underlying stock, the time remaining until expiration, and the difference between the strike price and the current stock price.
Okay, so those factors all play a role in determining how much we get paid
Exactly.
for selling those options.
Exactly. And once you understand how those premiums are calculated, you can move on to those profit and loss calculations.
Yeah. Okay.
And this involves assessing your potential profits if those options expire worthless,
Right.
or if you sell the assigned stock at a higher price.
Right.
And conversely, you also need to calculate those potential losses
Right.
if the stock price moves against you.
So we need to consider both the sunny day scenario,
Yeah.
where we keep the entire premium,
Right.
and the rainy day scenario,
Yeah.
where we might have to buy or sell that stock at a less favorable price.
That's a great way to think about it.
Yeah.
It's all about assessing that range of possibilities and understanding how different market movements could impact, your overall profit or loss.
And what about that break-even analysis? How
Yeah.
does that fit into the equation?
So break-even analysis helps us determine, at what stock price we start making a profit
Okay.
or incurring a loss on a trade.
Okay.
And for put options, the break-even point is simply the strike price minus the premium you received.
So it's like figuring out that magical point where our trade flips from red to black.
Precisely. And by regularly reassessing and recalibrating these calculations,
Yeah.
based on those market conditions, you can optimize your returns
Right.
and minimize those risks, ensuring a smoother and more profitable trading experience.
Awesome. This has been really helpful in demystifying that math behind the wheel strategy.
Good.
But to solidify our understanding, can you walk us through a real-world example?
Absolutely. Well, let's consider that fictional case study of XYZ Corp.
Okay.
A well-established company known for its stable earnings and moderate stock price volatility, which is highlighted in our source material.
Okay, let's see how this wheel strategy plays out in practice.
All right, so in this case, a trader decides to implement the wheel strategy on XYZ Corp.
Okay.
They start by selling put options with a strike price of $50,
Okay.
and they collect a premium of $3 per option.
Okay.
The market price for XYZ at the time is $52.
So they're betting that the stock price will stay above $50, and they're getting paid $3 per share for taking that bet.
Exactly. But as we know, market conditions can change quickly.
Uh-oh.
And in this case, over the next month, XYZ's stock price drops to $49
Okay.
due to a mild market downturn.
Okay.
And those put options are assigned, meaning the trader is now obligated to buy the stock at $50 per share.
Okay, so now they own the stock at $50, but remember,
Right.
they collected that $3 premium up front,
Yes.
effectively lowering their purchase price to $47 per share.
You got it.
Yeah.
And instead of panicking,
Right.
the trader decides to continue with the wheel strategy.
Okay.
They start selling covered call options
Okay.
with a strike price of $55,
Yay.
collecting an additional premium of $2.50
Yeah.
per option.
So they're now hoping that stock price will rise above $55.
Right.
Allowing them to sell shares at a profit and pocket that additional premium.
Precisely. And as luck would have it, 2 months later, XYZ's stock price rebounds to $56.
Nice.
Thanks to some positive industry news, those call options are exercised, and the trader sells the stock at $55 per share.
So not only did they recover from that initial stock price drop,
Yes.
but they also made a profit.
Yes, and let's break down that profit.
Okay.
They collected that $3 premium from the puts and a $2.50 per premium from the calls,
Right.
totaling $5.50 per share in premiums alone.
Not bad for a few months' work.
Right. And they also made a profit on the difference between their effective purchase price of $47 and their selling price of $55.
Right, so that's an additional $8 per share.
Exactly. So in total, they made a profit of $13.50 per share.
Wow. This case study really highlights how the wheel strategy can generate that income through premiums,
Yes,
while also providing an opportunity for capital gains.
it does.
But what are the key takeaways here?
Okay.
What lessons can we learn from this example?
So I think this case really highlights the importance of thorough market research and stock selection.
Okay.
Choosing XYZ Corp, a company known for its stability, was really key to the strategy's success.
Okay.
It minimized the risk of those wild price swings that can really derail a carefully planned trade.
Right. You don't want to be riding a roller coaster when you're trying to execute the wheel strategy.
Exactly. You want a smoother, more predictable ride.
Right.
It also demonstrates the power of effective premium management.
Okay.
Collecting those premiums at each step, both from the puts and the calls significantly boosted the overall profitability.
Right.
It's like getting paid to wait for the stock price to move in your favor.
And finally, this case study underscores the importance of flexibility and adaptability.
Yes,
That traders' willingness to adjust their strategy based on those changing market conditions was crucial to turning a potential loss into a significant profit.
precisely. It's all about being a skilled captain, navigating those ever-changing currents of the market.
Now, you mentioned a tool earlier that can
Yes.
help us maximize the effectiveness of the wheel strategy.
Right.
What was that again?
The Insider Finance Options Profit Calculator.
Right. It sounds like an invaluable resource for wheel traders, especially, for those who are new to options or want to streamline their analysis. Can you tell us more about it?
Yeah, absolutely. So this calculator allows you to actually visualize
Okay.
those potential profit and loss scenarios based on different market conditions, those strike prices, and those expiration dates.
Okay.
It's like having a crystal ball
Ooh.
that helps you see how your trades might unfold.
So it takes some of that guesswork out of options trading,
It does.
providing, those valuable insights that can help us make more informed decisions.
Exactly. The calculator provides that real-time data and analysis,
Oh,
allowing you to experiment with different scenarios,
okay.
assess those potential risks and rewards,
Yeah.
and fine-tune your strategy.
Gotcha.
It's a really powerful tool that can significantly enhance your wheel trading experience.
Sounds like a must-have for any serious wheel trader.
It can be very helpful.
But before we get too carried away with calculators and crystal balls, I want to emphasize that we're not endorsing any specific product or service here.
Of course not.
Yeah.
Our goal is to simply provide information and resources that empower you to make informed decisions.
Absolutely.
The choice of which tools to use is entirely yours.
Right now, as we wrap up this segment of our deep dive into the wheel strategy,
Yeah.
I'm curious to hear your thoughts on a particular aspect that's often overlooked.
Okay.
We've talked about, managing risk when the stock price moves against us,
Right.
but what about managing success?
Ah.
What happens when those covered calls we've sold are exercised and we have to sell our shares at a profit?
That's an excellent question.
Yeah.
It's something that a lot of traders don't fully consider
Right.
until they're faced with that situation.
It's like reaching the top of the Ferris wheel
Yeah.
and realizing you have to get off
Yeah.
and start a new ride.
That's a perfect analogy.
Right.
Managing success in the wheel strategy is all about having a plan for what to do with those profits
Right.
and how to keep that wheel spinning.
So what are some options for managing those winning trades
Okay.
and keeping that momentum going?
So there are several approaches that you can take.
Okay.
One option is to simply reinvest those profits into another wheel trade,
Okay.
either on the same stock or a different one,
Right.
depending on those market conditions in your analysis.
Okay.
This allows you to kind of compound those gains and keep that income stream flowing.
It's like hopping off one Ferris wheel and jumping right onto another one,
Exactly.
continuing that cycle of profit generation.
Exactly. Another option is to take some profits off the table
Okay.
and allocate them to a different investment strategy,
Okay.
such as, buying dividend-paying stocks, investing in index funds,
Right.
or even simply holding cash.
Okay.
This helps diversify your portfolio
Okay.
and reduce your overall risk exposure.
So it's like enjoying some of the winnings from your Ferris wheel ride and then deciding to explore other attractions in the amusement park.
That's a great way to put it. And finally, you can also use those profits to further reduce your cost basis on the original stock.
Okay.
So if you believe in the long-term prospects of that company,
Right.
you can use those profits to buy more shares at a lower price,
Okay.
effectively averaging down your entry point
Right.
and increasing your potential gains in the future.
So it's like using your winnings to buy more tickets.
Yes.
For the same Ferris wheel, knowing that each ride is going to be even more profitable.
Precisely, managing success in the wheel strategy is all about having a plan, being flexible, and continuously adapting to those ever-changing dynamics of the market.
This has been incredibly insightful.
Good. I'm glad.
It seems like the wheel strategy is not just about, the mechanics and calculations.
Right.
It's also about understanding the psychological aspects of trading,
Yes.
managing risk effectively, and having a plan for both success and setbacks.
Absolutely. It's a holistic approach that requires a blend of technical knowledge, strategic thinking, and emotional discipline.
Speaking of holistic approaches, we haven't really touched on how the wheel strategy fits into an overall investment portfolio.
Okay.
Is it a standalone strategy, or can it be combined with other investment approaches?
That's a great question. The wheel strategy is very versatile.
Okay.
and it can be integrated into a variety of investment portfolios.
Okay.
So for investors seeking that consistent income, it can serve as a core component, generating that cash flow,
Okay.
while also providing opportunities for capital appreciation.
So it's like having, a reliable engine that
Yes.
powers your portfolio,
Yeah,
providing steady fuel for growth.
exactly. And for investors with a more growth-oriented approach,
Okay.
the wheel strategy can actually complement those existing holdings,
Okay.
adding an income-generating element to a portfolio that's primarily focused on capital appreciation.
So it's like adding a turbocharger to your portfolio,
Yeah,
boosting its performance with that extra kick of income.
that's a great analogy. The key is to determine how the wheel strategy aligns with your individual investment goals, your risk tolerance, and that time commitment.
Right.
It's not a one-size-fits-all approach.
Right. It's about finding the right fit, like choosing the right Ferris wheel for your thrill level.
Yes.
And your desired ride duration.
Precisely. And remember, diversification is key to any successful investment strategy.
Right.
Don't put all your eggs in that wheel strategy basket.
Right.
Consider allocating a portion of your portfolio to other investments
Okay.
that align with your overall goals.
So it's about creating that well-balanced portfolio.
Exactly.
Like a well-designed amusement park.
Yeah.
With a variety of rides and attractions to
Good.
suit different tastes and preferences.
Exactly. And just like a well-run amusement park requires constant attention and maintenance,
Right.
managing your investment portfolio requires that ongoing monitoring those adjustments and a willingness to adapt to those changing market conditions.
This has been a fantastic deep dive into the wheel strategy.
Good. I'm glad
We've covered a lot of ground.
we have.
From, those basic mechanics to those advanced concepts like managing the Greeks,
Right.
customizing the strategy to fit your own investment goals,
Yeah.
and even integrating it into a broader portfolio.
Yeah.
But before we wrap things up, I want to leave our listener with a final thought-provoking question to ponder as they continue their exploration of the wheel strategy. We've talked about finding the right stocks and, managing that volatility and even what to do with those profits. But I'm wondering,
Yeah.
how can you actually adapt the wheel strategy to fit your own, investment goals and risk tolerance?
Yeah, you're absolutely right. The wheel strategy isn't a rigid one-size-fits-all approach.
Okay.
It's more of a framework that you can tailor to your specific needs and preferences.
So it's like having a set of building blocks
Right.
that you can arrange in different ways to create a structure that suits your individual style.
Exactly. For example, if you're more risk-averse,
Yeah.
you might focus on stocks with lower volatility and choose strike prices that are further out of the money,
Okay.
which reduces the likelihood of assignment, but also might mean slightly lower premiums.
So it's a trade-off
Yeah.
between that potential income and the probability of actually owning that stock.
Right.
What about investors who are more comfortable with risk?
Yeah.
How might they adjust the strategy?
Well, they might opt for stocks with greater price swings
Okay.
and choose strike prices that are closer to the current market price,
Okay.
potentially generating higher premiums,
Mm.
but also increasing that chance of assignment.
Gotcha. So it's like choosing between, that leisurely Ferris wheel ride and a more thrilling roller coaster.
Yeah, that's a great way to put it.
Okay, so it's all about finding that sweet spot on that risk-reward spectrum that aligns with your investment personality.
Right.
But it's not just about strike prices, right? What other levers can we pull to personalize the strategy?
Well, expiration dates are another key factor.
Okay.
Your shorter-term options offer those more frequent income opportunities, but they demand more active management.
Okay.
Longer-term options provide greater flexibility and potentially larger premiums,
Okay.
but they require a longer time commitment.
Right.
So it all comes down to your trading style and how much time you're willing to dedicate to managing those positions.
Right. It's like choosing between a series of short sprints or a marathon.
Yeah.
Both can get you to your destination.
Right.
But they require, different approaches and levels of commitment.
Exactly. And don't forget about position sizing.
Okay.
You can adjust the number of contracts that you trade to align with your risk tolerance and your account size.
So it's not just about picking the right stocks and the right options. It's also about managing your exposure
Right.
and ensuring that those trades are aligned with your overall financial goals.
Precisely. The wheel strategy is a very versatile tool
Okay.
that can be adapted and refined to create that personalized approach that really suits your individual needs and preferences.
This deep dive has been incredibly insightful.
Yeah.
We've gone beyond the basics of the wheel strategy and really explored how to leverage its flexibility to create a truly customized approach.
Yeah.
Any final thoughts for our listener as they embark on their own wheel strategy adventure?
Well, I think the beauty of the wheel strategy is that it's a journey of continuous learning and refinement.
Okay.
So as you gain experience, you'll develop your own insights, adapt the strategy to fit your evolving style,
Right.
and discover new ways to navigate those ever-changing dynamics of the market.
It's like becoming a master Ferris wheel operator,
Yes.
constantly fine-tuning the ride to create that perfect balance of thrills and rewards.
Exactly. And remember, just like a skilled Ferris wheel operator, prioritizes safety and enjoyment.
Right.
Approach the wheel strategy with a focus on risk management, calculated decision-making, and a genuine passion for the art of options trading.
That's a fantastic way to wrap up our deep dive into the wheel options trading strategy.
Well, I agree.
We've covered a lot of ground, and I hope you're feeling equipped and inspired to put this knowledge into practice. Remember, the world of options trading offers endless opportunities for growth and learning.
It does. It's a fascinating world.
Thanks for joining us, and remember to keep exploring, keep learning, and keep reaching for those new heights in your financial endeavors.